Hello everyone. Right. I'm pretty sure all of you have been to the in-persons, but we're basically just going to start everything from scratch. Yeah, the plan is we start everything from scratch. We're going to go through the entire process of just making sure we've covered everything. We've got a trading view on one screen, although I'm not actually sharing. Hold on, let me just share the right thing. Screen 2. Alright, everything is being shared. We will be going through, we're going to cover basically everything we've covered in classes, supply, demand, and order blocks and all that jazz. Nesting, fair value gaps, blah 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 blah. We're going to cover indicators, we're going to cover all kinds of things. And then at the very, very end, we'll look at building systems, testing systems. That will be including, let's just go into a chart. We'll also include a bit of back testing, stuff like that. You will have a copy of being able to a blank copy of this spreadsheet, so you'll be able to go and do the style of testing I would tend towards, because then you can start breaking down your wins and losses by hours and stuff. But the plan is pretty simple. We're just going to go through and cover as much as we can in one session, right from the beginning. So if we start, we only recorded one of them, and basically this call will supersede that. So you don't need to have been there, but this call will supersede it. I'm just going to very quickly respond to a WhatsApp message. Right. First things first, we need to look at your basic terms and terminology. Nothing's going to be overly wild, so we're going to just sort of discuss basic terms. Yeah. Spread. How do you define spread? It's your ask and bid price or the difference between them. So in this case, it's this blue line to this red line. So the difference between those is your spread. So if you were to have taken a buy trade, it's going to give you this price, but quote you to sell at this price down here. And if you were to take a short, it's going to give you this price, but this would be where your stop loss is currently at, because that's where you're going to be buying at to exit the position. That's spread. We're going to need to know what is a pip. In most forex pairs, it's going to be your 5th decimal place, so that would be this one here. In things which are quoted in 3 digits, like these, it's often going to be the 3rd digit. Sometimes, depending on your contract size, it'll be the 2nd one. Gold, a lot of brokers these days are giving it on the 2nd decimal place. Giving it on the 2nd decimal place, not the 1st. Although I have seen some which do give it on the 1st. I think Ava Trade is one of the ones that does it to the 1st decimal place at the moment. But that's mostly due to contract sizing. Gold is pretty much the 3rd decimal place, quite usually. And then you'll get things like where's NAS gone there? NAS. Most people, when they trade NAS, will be getting it off the full point. If you're trading futures, you'll get it on a quarter point. So with futures, this won't run as a continuous number. It goes 0, 25, 50, 75, 1. So you would get it on the 25 or the 50 or the 75. You wouldn't get it on a full point. BTC can be entirely dependent on your leverage and contract size. So most places will be doing it to the full point, the full dollar. Some places you can get it quoted to decimals, but not very common these days. That can be turned off. We're not needing that today. Right. Next thing, what is a tick? A tick is basically what I said about futures with NAS. You do 1/4 of a point, so you'll. If I just go Q. So you would do, you see how it's on a 75 or a 0? It goes 0, 25, 50, 75, 1. And that's how futures work. And each one is a tick, not a pip. Although the term is basically interchangeable. Contract dates. Something useful to remember is that for Forex, for things like oil, you have a contract date. So if I go to oil, you'll be able to look up when the contract date ends and starts. I've got this set to WTI because that's essentially the perpetual contract, which just means it continually updates. It does become important, especially when you end up with things like that. The reason this happened was because all the land storage was full and contracts had to be closed, which meant people had to take delivery. No one wanted to take delivery because that's exceptionally expensive with oil, and so the price went to 0. On TradingView it only shows it going down to 8, but in reality it went down to like negative $37 a barrel or something. And yes, that means you could have gone to the refinery and asked for a barrel of oil and they would have given you $37 for taking it. But oil has a date. Gold technically has a date. You can look it up, but most people will trade spot gold, which is perpetual. It doesn't have a contract date. You can trade gold where it's dated, but it's pretty gold futures. Yeah, you can trade gold futures, and it does have delivery dates associated with it. In the same way you can trade FTSE 100 with a futures contract, you can trade DAX, which is the futures version of Nikkei. There's all kinds of other ones for futures. In general, futures contracts are... The thing I like about futures contracts is they're more regulated, so if you're looking to trade a prop firm, I would say pick a futures prop firm, don't pick a Forex one. If you're looking to trade personal money, then either is fine. But I always find for a prop firm, when I'm assuming most people here will want to trade on a prop firm at some point because it's access to big capital, pick a futures one. Top Step, Apex, Funding Ticks, there's a few of them out there. Anything else on this list that we need to cover? Other basic housekeeping. I guess we can briefly say, right, if you are someone who's traded candlestick patterns, like bearish engulfing, bullish engulfing, all of that sort of thing, we are probably not going to cover it today because in general I do not care nor believe in it. Do I know it? Yes. Is it worth knowing? Maybe fractional. Am I going to teach it? No, because I think you can do perfectly fine without it. Alright. The only other thing that you might want to grab is if you can get yourself off of the slideshow, you can grab yourself a copy of Forest Factory, because we will briefly discuss reading news only as far as pretty much don't trade when red news is coming. So like if I go and look at Monday, I wouldn't be trading CAD for about an hour before or after that. It's not worth it. In fact, I probably wouldn't place a CAD trade all day because I know that that's coming. And then I might look at placing a CAD trade an hour or two after. Could I? Yeah, sure, especially if my method says that it's fine to do so. But would I? No. That's red. Now, the other thing I would also be aware of is that if something is in a bank holiday, try not to trade that currency. You're more liable to see flash crashes. A la 2020, is it 2019? Yeah. Wow, it looks so tiny on there now. This one, it would show on the daily a bit better, but January 2nd, that one. You don't want to be caught in flash crashes like that. I've been there, I've done that, I was caught in that one. Don't do it. Bank holiday, innit? So don't bother trading a bank holiday, because you are more liable to see flash crashes. Now you will see other flash crashes like... Okay, it's not on my list. Here's CHF. This one. Yeah, it's massive. But realistically, unless you knew the fundamentals, the only reason that happened was fundamentals. It's not a bank holiday or anything. Were you able to know it was going to happen? In theory, kind of, but not really. Like, 9 out of 10 traders had buys, and then it went down. And this happened in seconds. So realistically, you were probably not the one catching that. For anyone wondering what happened, running in through this period of time here, Swiss government said that we will peg ourselves against the euro, so we cannot go lower than 1.2. Then they did. They got to a point where they kind of said we can't hold it, and just said that they weren't going to bother, and when they said they weren't going to bother, it just dropped. But in general, don't trade high red news, don't trade bank holidays, because there's no point. During this week, what else would you see? You would see GBP news. Again, that's all in the morning, so by the time that's finished, you can go in. I would probably be starting that day at midday. Anything else of interest? You got USD news. Him speaking is always a big worry. Basically, I would not trade USD news until probably like 4 PM that day. The big thing is just avoiding news. If you can avoid the news, then you can tend to make the smarter decisions. Key point. This is not how the banks trade, it's not how the banks will ever trade, and it's not how the banks have ever traded. Do you believe in trading a specific time window every day? I kind of like trading a specific time window every day, but I don't think it's necessarily important. Like, if you've always traded different times, you'll get used to knowing the different times of the day, and different methods work better at different times of the day. So for instance, if I was to show you this, let's just go to the combined sheet where that's working. There we go. Like for instance, I know that there's certain hours not to bother, then I wouldn't trade them. But I know that there's hours which are good, so I would. But in general, would I trade a specific time of the day? It's quite nice to do so. You get used to how things move. I would just try and pick a consistent time where you're not running into end of day handover. I don't see any point in anyone trading from like 7-8 PM at night in the UK onwards until maybe like 2 AM. And try not to have it fixed during your heavy news sessions, which are like 1:30 in the afternoon or 7:45 in the morning. Try and avoid those as well, because you've got to avoid the volatility. I'm not saying that you can't trade through news, it's just a lot harder to do so. And if your session was always in a comfortable time, like if it's 3 in the afternoon, it's going to be pretty chill, and you'll find that the moves are pretty smooth. In the same way, if you trade like 9 till 12, you'll probably be alright. like I was saying, this is not how the banks trade. It's not how they will ever trade. I'm going to be about to teach you a lot of like your standard ICT and SMC stuff. If you ever want to go and work in a bank, just ignore all of everything that we're about to talk about, because that's not how they do it. It's not how they'll ever do it. And it's not how they've ever done it before. All they're going to do for trading Forex is hedge out positions. If they have 100 million USA stocks, then they'll decide that they can start playing with the dollar itself to reduce their leverage, exposure, and playing with stocks and currencies is a lot easier to reduce risk. Now, if you're like me, who's been trading since 2018? Yeah, 2018. You're going to have seen a lot of things but that are the same thing by different names. And realistically, a lot of the following things I'm going to teach you are basically the same thing, but repeated in slightly different ways. They all do the same thing, they're all the same. If you know one of them well, you technically know all of them, just you might not know the nuances of different variants. So, zone-to-zone theory. Pretty straightforward stuff. You're basically looking for areas where you've got a bunch of wicks, and you try and plot them on a chart. Now, some people do it with lines. It's not really a zone if it's a line, and I always find zones are a bit easier. You can grab a good range of the wicks, you kind of make some tops and bottoms, grab a good range of wicks, see where things are testing against. So on something like this, if we just drop down into the time zone a little bit, let's not pick that pair because it's not going to be a good one. This one will be. You just kind of go in here and grab where you think is important, so probably something like that. Just picking up all the bottoms of these wicks mostly, get some of the little higher ones. I could probably realistically come in and do another one in through here like that. Again, you're grabbing a lot of the wicks, not getting many bodies that break straight through. There is a few, but ideally you don't want many of that. Might actually drag that up slightly higher, like there-ish. I kind of want it to touch, so probably like that. Or I'd end up making that one slightly wider, either or. Again, we can just pick up straight through here somewhere, about there. Again, picking up 1, 2, 3, 4, 5, 6, 7, 8, 9 points. Could I go for another one? They are about in line. Probably somewhere here. Probably like that. Could I keep going? Yeah, I could grab this one, go 1, 2, 3 off there. I could grab this double top. You get the point. If you want, I will go do a couple other pairs, why not? Let's just do a little bit. How am I going to grab that? We're going to go straight through here. We would go straight off the bottom here somewhere. We would go, I'd want to go through the middle somewhere, about here. It's not the prettiest thing in the world because this has got a top and a bottom. Might end up splitting that. Going like that. Then I'd end up with another one off the bottom of that. See, I don't like it because of these. Realistically, I probably shouldn't put that one in. And then I can grab another one off the top of this somewhere. And grab those wicks there. I could probably grab here. It's only 2 points, but technically it's enough. Basically, the more points, the better. how do you trade it? You're basically looking for the same repeated pattern every time. So in the case of a downwards market, you're looking for it to go like this, like this. Let's just move you like that, or like this. The most, I would say that this one and this one are the most common. This one is probably the least common of the three. And if you can imagine them going up, it would look exactly the same. So going up, you would have one like that, one like that, and one like that, where this one and this one are the most common. Now, you will also have rejections. They tend to look almost all the same. You will either have one where it does this, one where it does this, or one where it's going to do this. This one's the least common because it's already broken through. This one's probably the most common. This one's probably the second most. And then the only other option will be when you have it where it does 1, 2, like this. This is quite common. The reason being is it's essentially trying to fake you out. So you'll get loads of people going in for this. And you basically just have to watch, and you'll see that it's going to throw some wicks, and then one candle will go up quite aggressively. That's when you'll know that it's just going to do that. Do we want to find some examples of that? Sure. So if we are looking at the M, this is where I'd call it an M and a W. Right, there's one M. You can see it throws a few wicks. It doesn't really break the previous high. Really hard to look at this one post, like during it, because you've only had one high. Realistically, the only way you're going to ever really judge it is something like this, where it's the second or third. This one, if you were to have drawn it off this top, you would have seen it break through, and then you would have probably thought the same. But by this time, you can see that it hasn't really made anything. It touches up briefly, and then immediately starts trying to push back down. Once you've done that, you're kind of pretty sure you're going to come down to the bottom of it. So this one is the easier one to trade. You're only ever trading the fourth leg of an M or W. You're never trading the first. Because it's impossible to trade this leg of a, well, I mean in this instance you've actually got a W here, but if for instance you wouldn't necessarily trade this one up to here, it's not very easy to tell, in the same way that it's easier to tell this one because it's essentially the fourth leg, so 1, 2, 3, 4, and you would trade this one because it's a fourth leg, 1, 2, 3, 4. This one, it's very, very hard to tell. I would have probably not entered in the buy off of this one, just simply because I don't like the price action that went with it. It exploded away very quickly, but yeah, I probably wasn't grabbing this one, because by the time you've bounced off a few times, it gets a bit rocky and you start questioning if it will still hold. But with zone to zone, like I said, you're just looking for that same pattern repeatedly. So if we go back into here, briefly talk about it in this slide, and I'll show you a bunch of examples where you can see 1, 2, 3, 1, 2, 3, the straddling one, and again for the downwards direction. They're all pretty much the same. We've done it in a different order because I just went through and did it with you, but order blocks. This one's slightly different. This is probably the most different one of all the categories we're going to go into. The reason I say that is because they are just drawn differently. Here, if I zoom that one out, you can see it's the last, in this style of them, it's the last, if we're looking in the downtrend, it's the last upward candle in a retracement. You will also have it where it's the last downwards one before the retracement, so you would have had one here here and here as the other type, which we will cover in a minute. If I go back to the chart, we can start plotting some very quickly. So if I grab this, the style that we just looked at was the last one before. So it would have been this candle, for instance, because we're in an uptrend. It would have been this candle, for instance, because we're in an uptrend. And it would have been this candle, for instance, because it would have been an uptrend. And the way you would mark it out is you would basically take this, you would grab that. Some people do it to the whole length of the candle, some people do it to the body. I'm just going to do it to the whole length of the candle. I think it's the better way of doing it. It's the safest way of doing it. So you would end up with your order blocks looking like this, with the idea that at some point in time they're going to go and retest them. You can note that these ones have never been retested yet. Now, we'll cover time to live later and then it'll make more sense. And here's the other type. The other type, as you can see, is the last candle before it pulls back, which would be, if I go get rid of these again, this one here. See that one's a particularly big one. It would be this one here. It would be, technically you could mark this one because it does technically make a new high, barely. It will be this one here. And it would also be this one here. And I could go mark the next one up here, but I'm not going to. Oh, well, sure. This one here. You can see that's just the last candle before pullbacks happened, really. Sometimes what I would do is I'd pick them off a higher time frame, and then I can use them on a lower time frame. Supply and demand. Yeah. So we'll go for supply and demand. You're going to have to look for the fair value gaps. Then you need to find a candle that starts with the fair value gap in the sequence, and you can do it like that. Here's some examples. You'll see little fair value gaps and it's the first candle. So if we find a fair value gap like this one, so it'd be that one. And then for a bearish one we can grab this one, because your fair value gap is here, and you might be like, well, what's a fair value gap? You haven't covered that yet. We'll cover it in 2 minutes. But we will just quickly zoom in on some. Which one's on the front? It's this one, isn't it? Yeah. You can see that on this one, this is the first one of a fair value gap, this is the first one of a fair value gap, this one was the first of a fair value gap. You're basically just looking for fair value gaps. You haven't been told fair value gaps yet, but that will come in about 10 minutes time. We are blitzing through the content, which is good because it means that it's a shorter zoom. If anyone has questions on anything so far, let me know, because then I can stop and address questions. So congratulations, you've now learnt supply and demand in a bunch of different ways. You can see this, I guess.
But it's the opposite. My father had taught me, looking at a bird, he says, you know what that bird is? It's a brown-throated thrush. Portuguese, under la terre. In Italian, tutta la picchia. He says in Chinese, it's a tung long pop. In Japanese, a patata podecha, etc. He says, now you know all the languages you want to know what the name of that bird is. And when you're finished with all that, he says, you'll know absolutely nothing whatever about the bird. You only know about humans in different places and what they call the bird. Now, he says, let's look at the bird and what it's doing. He knew the difference between knowing the name of something and knowing something. Which
if you don't know who that is, that's Richard Feynman, theoretical physicist, founder of Feynman graphs. Worked at Los Alamos and was on the board for the Challenger Disaster Council. In fact, he was one of the people that pointed out it was the wrong grade of O-ring and it went brittle. But yeah, basically all I've just taught you is the name of a bunch of the same thing. Fair value gaps then. And they're pretty easy to spot. What is a fair value gap? It's where the wicks of two candles don't touch. So this is a bearish fair value gap because the first and the third candle, the wicks don't touch. You'll see that doesn't happen very often. Well, yeah, it doesn't happen very often. They can be very small at times, like that one, or they can get really small like this one, and sometimes they can literally just be like 1 or 2 points. In theory, they're supposed to show that the market is imbalanced and it's a price where it will want to go again. You can see there's a few here. Look how tiny that one is, but usually they're a little bit bigger. You can see enough. This again, anatomy. There's a wick, there's a wick, there's a gap between the two. Pretty simple to spot. In fact, we'll go and grab a bunch of them. Let's pick something like that one. Now this is a pair with a lot of liquidity, which means you'll probably find less of them, but we will do our best to find them. You have a fair value gap here. I've managed to pick one which happened to have a lot today, but technically this, well, you actually have a chain of fair value gaps here, which is a good point to make. In a chain of fair value gaps, I tend to only worry about the one at the bottom or top, so in this case this one. I did not mean for that to make it. In this case this one, because they get progressively weaker the higher up the chain. And are there any other fair value gaps we can see? Yeah, this one here. There's one here. Like I said a minute ago, I wouldn't worry about this one because you've got this one. If you're looking for bearish ones, you've got this one here and this one here. But what did we say before? We're not necessarily worried about this one if you've got this one. In this case, it is actually that one that gets tested, but you have one here, you have one here. There is one here. One here. In through here. That one's technically a really small one, but you'll find them. Yes and no. We will discuss that in about 3 seconds. I just wanted to make sure that you've seen enough of them, and that was a good 20 examples, so that should be fine. This is where it becomes important. Nesting. Now, if you have found one on a high time frame, let's go and find one on the daily. Right, so we have one off the daily. If I can then go and find one in that range, on the, in this case, the 1 hour, which I can, and then if I can go and do that on the 15 minute, for instance, in that range, which I can. In fact, there's two. I'm going to pick this one. In fact, no. I'm going to follow my rule. I'm going to pick the bottom one. That one. We would be looking that the most important level we can possibly find would be where the three of them intercept, and that would be the strongest point. So higher time frame ones mean more than lower time frame ones, but what means even more is if you can get multiple in the same direction, all overlapping. So in this case you'd have three right there that I would then try and get price into that level and take it from there. Now I probably in theory could have drawn another one from here somewhere, but we didn't necessarily look beyond the daily, so it's irrelevant. But yeah, nesting is important. The other thing I would say is that don't nest bullish and bearish runs. So if you have one like this on the daily, and then you had one like this, but it was on the 4 hour and that one was going down, I don't like it when they're in inverse directions. So only bullishes together, only bearishes together. Some free resources. I think these are books. Yeah, they are. These are Elliott Wave Theory books. Elliott Wave Theory is a really, really, really good thing to learn. Elliott Wave Theory basically states that every market has cycles, and it goes into counting the cycles and how they look. So if I just quickly... You can break... Okay. You can break things down and you'll have the standard 5-wave cycle, 13-wave cycles, so on and so forth. There's a lot of images and diagrams here. You've got wedges and stuff, all on a much more technical level than you'll find in most other Forex books. For instance, these, you've got zigzag patterns which are like that. You'll find that within these two books you're going to cover pretty much everything we have and haven't covered today. There's a lot you can learn. This one's fucking huge, it's 256 pages. Excuse me while I quickly open some Haribo. The slides are in WhatsApp, but I'll reshare it now. Hold on. There you go. I'll just share that with you there, and then I'll put it again in the WhatsApp later. I would open it, but it will open in this tab, I think. So right near the beginning of this, when I was going through support and resistance, I mentioned that they get weaker over time. This is where I would like to quickly introduce the concept of time to live. If you're from a IT background, you'll understand time to live inherently, because that's how the internet literally works and networking works, because everything has time to live on a signal, and if you don't get a response within X time, the signal dies. Finance is the same. I mean, he wrote this in 1838, and if you can write that in 1838 and it still holds true, you're probably not far wrong. How do I look at it? Every time you see a zone, an FVG, trend line or anything, it's got a finite lifetime before its strength has decayed to the point where you can break through it. So if you see an FVG on the 1 hour chart, or you draw a zone on the 1 hour chart, it's probably only good for a day or so. If you see one on the daily chart, it'll probably be strong for a month, maybe 2 months. But eventually it'll be consumed. So if I scroll way back in time, I mean this is the 15-minute chart, so it's irrelevant, but if I scroll way back in time and found, I don't know, this fair value gap. Okay, there was no fair value gap there, my eyes deceived me. This fair value gap, whoops, by the time you get price all the way to now, it'll have run through it 3 million different ways, and it doesn't really mean anything. I mean, even by the time you get here, you're just running straight through it like it don't exist. I would say it's pretty much decayed by that point. Yet by this point, you can see it's kind of interesting, but by the time you get here, it's just straight through, up and through, up and through, up and through. You're not really doing anything with that. Zones decay, fair value gaps decay. If there's sometimes what I'll do is at the beginning of a month, if I'm going to do clean charting, wipe off all the old stuff, start again. It resets your mind on how you're reading it and give you new biases. So just feel free that like once a month or so, just clear your charts and start again. And I drew a few examples. You'll see this one was pretty recent, so you had 2 good taps and away it went. This one was a couple of days, so you had 1 good tap, it went off quite well, and then it came back through and just went straight through it like it weren't even there. Fib retracements. Right. It's going to be quite in detail. Right. Fib retracements. We're going to start with the conventional way of drawing one. Conventional way of drawing one, you're going to go from the high of the wick to the low. So it's going to look like this. From the high to the low. Some people draw off the bodies, some people draw off the wicks, some people mix and match. I would say if you're drawing it off the bodies, you're wrong. It doesn't look right, and I never get the right results drawing it off the bodies. So draw it off the wicks if you can. Obviously, if something has no wick, then obviously you're going to draw it to the body, but chances are it'll have a wick. You can see you get some solid enough bounces. They always look good postpartum, so obviously you can't really trade from it right now, because you have no accurate way of telling if this is the end or not. You could basically, you're just looking for a rejection when you get here. So what I would do is I'd see that we're now, for instance, here. Am I going to reject off of it? Let's not drop down to the 5, let's drop down to the 15. And I'm looking for other signs. So for instance, you've got head and shoulders. Shoulder, head, shoulder. This is a last rejection, so chances are we'll work our way back down. Very, very high time frame fib. So your moves take a long time, but you might get there. I don't know. How far into the future is that? Like end of February? Yeah, you might get there mid-February. But the point remains, you don't have to do it on that time frame. If we're on the 15-minute, for the hourly, I like an hourly one sometimes. Where would I draw it on this? I would have probably had one drawn here to here. There we go. Realistically, this is all just consolidation. I'm not drawing it anywhere in there. You can see that we're consistently making lower highs. This was a previous high, and highs I worry about bodies. So higher highs, higher lows, etc. You look at bodies, you don't look at wicks. Wicks can be misleading. You made a high. You technically did make a higher high after this one, but this never broke the previous low. So you made a new high, you came down a bit, you didn't break the low. You didn't break the low because it didn't go further than this. You came up, you made a slightly lower high, and you're continuing to move down. Your position's going to look something like this, and your goal would be whatever your target down there is, which would probably be like here somewhere. Am I advocating you take that trade? Absolutely not, but could you in theory? Yeah, probably. But this is plotting with standard fibs. You basically go wick to wick and you're looking for rejection of zones. If you could have seen that as a good rejection of a level, then you can take it. It's not always easy to get a clear-cut idea, and part of that is because you will be debating with yourself. The easier way of drawing them, which is my way, and you'll pretty much never see it otherwise. The way I like to draw them I look at the round numbers. Now, with a Fibonacci retracement, you have to consider that the concept of a fib retracement is it's a psychological tool anyway. So if I'm picking a psychological tool and I'm not drawing it based off the most important psychological numbers, then what am I actually doing? So I might as well pick the big round numbers. So in this case, I'd be picking between 0.6 and 0.7. Like so. Some things they move a little bit too slowly, so Audius is not really great in terms of speed, but you can do it like that and you'll get pretty pinpoint precise taps quite regularly. If it's too low in resolution, which most people aren't trading this high time frame, all you do is you do a smaller one, so you would grab there to there, and then you've got all the details. If you really needed to, say you were scalping on like the 5 minute, you could do a even smaller one still like that, and just nest them until you get to the right amount. But in general, this is a 5 minute chart, you can trade that quite comfortably. And then you use it from one level to the next. Yeah, we can do it on... I'm going to just do it straight onto NAS 100 because I've got it on my list instead of going and finding. But you know what we'll do? Enki. Enki. Get rid of the Haribo, great, too many. Alright. This one depends if you're scalping or not, but I would always tend towards 10 to 20 thou. That's 10. That needs to be 30. Thank you. That's not what I want. Let's try that again. 20, 1, 2, 3, to 30, 1, 2, 3. It gives you a reasonable good amount to go through, and then if you need to go smaller, grab one line, go to the next line. You can type in the numbers, but I just didn't because it's quicker. And you can get enough detail in there. You'll see that on that time frame you can get there pretty close. I mean, nothing's ever going to be dead perfect, but you'll get pretty close. Now the other way you can do it for NAS would be in 1000 ranges. So if I went to go like 25, 1, 2, 3 to 26, 1, 2, 3, and this again is where you're more scalping, but you can go in 1000 ranges. Basically, you plot it between a round number and a round number. So I wouldn't do like point, like I don't know, 25.5 to 26.5. No, but 25 to 26, sure. Amusingly, this is what my dissertation is on. For some reason, I ended up doing this style of Fibonacci retracement as my dissertation topic, but that's because it works as a market anomaly, and it's worked for years, and I'm going to keep using it until I finish my dissertation and find that it probably decays. Right. But yeah, that's how you draw. This is how I would draw a fib, and it just works better. Key point of note: when I draw them, I always make this the small number and this the big number, which means it's technically drawn upside down. The numbers I use in the middle are those. So they're all relatively normal numbers for a fib retracement. Right. This kind of pretty much concludes the clean chart section. Do people have questions so that I can answer them? And then we'll move on to trading with indicators. Don't need that, I don't need that. Leave that for now. I'm going to give you like 2 minutes to write up questions. I'm going to quickly use the bathroom and I'll be back.